Welcome to the Microcap Brief. In January 2021, a dying video game retailer, left or dead by Wall Street, declared war on some of the smartest investors in the world, and won. The stock exploded over 1,700% in a matter of days, creating fortunes overnight and bankrupting hedge funds. What happened? It's a phenomenon called a short squeeze, and today we're breaking down exactly how it works and the critical warning you need to hear before ever trying to chase one. That company, of course, was GameStop. Its story is the most famous short squeeze in history. To understand what happened, you first need to understand the simple mechanics of a short squeeze. Let's use an analogy. Imagine a theater that has exactly 100 chairs. A group of short sellers is convinced the theater is failing, so they borrow all 100 chairs and sell them, promising to return them later. Now, there are no chairs left in the theater. Suddenly, the theater announces a blockbuster new show. A massive crowd rushes to the entrance, all wanting to buy a chair. At the exact same time, the people who lent the chairs to the short sellers demand them back. The short sellers are now trapped. They are legally required to buy back 100 chairs to return them, but a huge crowd of new buyers is also trying to buy those same chairs. The demand is overwhelming, and the supply is zero. What happens to the price of a single chair? It goes to the moon. That is a short squeeze. Now, let's apply this directly to the GameStop story. In this case, GameStop was the theater. By 2020, it was seen as a failing business. Major hedge funds were the short sellers, and they borrowed and sold a massive number of GameStop's shares. But they got greedy. At its peak, an astonishing 140% of GameStop's publicly available shares had been sold short. To use our analogy, this wasn't just a crowded theater where all 100 chairs were borrowed. The short sellers had somehow borrowed and sold 140 chairs. They had sold tickets for chairs that didn't even exist. This created a powder keg. All it needed was a spark. The spark came from a growing community of retail investors on Reddit's WallStreetBets forum who were inspired by bullish analysis from figures like Keith Gill, Roaring Kitty, and new strategic direction from investors like Ryan Cohen. They were the massive crowd that saw how vulnerable the short sellers were. Starting in January 2021, they began buying shares and call options in a coordinated effort. This pushed the stock price up, which forced the short sellers to start buying back shares at higher and higher prices to stop their massive losses. This created the perfect feedback loop. Retail buying forced short sellers to buy, which pushed the price up even further. The stock went from around $17 to a peak of over $480 in intraday trading, and even briefly surpassed $500 in pre-market activity. So how do you spot a potentially crowded theater in the stock market? You look for those two key ingredients that were present in GameStop. The first is an extremely high short interest. You're not looking for 10% or 20%. A true squeeze candidate like GameStop often has over 40% or 50% of its float sold short. The second ingredient is a high days to cover. You can calculate it yourself by taking the total short interest and dividing it by the stock's average daily volume. When this number is high, say well over 5, and certainly if it's over 10, it means the shorts are trapped and would need many days of heavy buying to cover their positions. But now, we come to the most important part of this entire video, the warning. Here is the part of the GameStop story that is often forgotten. For every person who became a millionaire, there were thousands of others who bought at the top, caught up in the hype, and were left holding the bag. After peaking, the stock collapsed over 80% in a matter of days. Trying to time and trade a short squeeze is not investing. It is high-stakes gambling. These events are rare, brutally volatile, and the hedge funds you are betting against have more capital and better data than you do. You are bringing a knife to a gunfight. Your key takeaway is this. It is vital to understand the mechanics of a short squeeze so you can recognize the phenomenon when you see it. The GameStop story is a powerful lesson in market dynamics, but you should build your portfolio on diligent, fundamental research, not on chasing market manias. Your homework. Using a financial website, find a company with a short interest of over 20%. calculate its days to cover, and post the ticker and your result in the comments below. Let's see what we can find. Thank you for listening to the Microcap Brief. Do your own research and invest wisely.